Hello, ladies and gentlemen. My name is Greg Michalowski from ForexLive.com. I'm going to take a look at a lot of the major currency pairs this morning as we head into the new trading week. But before I get into that, it is going to be a key week in the markets. Why? Because the Federal Reserve will meet on Tuesday and Wednesday, announce their interest rate decision on Wednesday at 2 p.m., followed by the press conference from Chair Powell at 2:30. The expectations are for a rise of 75 basis points. There's about a 20% chance of a 100 basis point rise according to pricing, but that has largely been taken back over the last week because of the weaker data that in the U.S. and housing. We saw it in the sentiment numbers, so on and so forth. And so that idea of 100 basis points has been scaled back. Now, a rate rise of 75 basis points would still take the rate to what Fed officials have called their neutral rate. That is 2.25 to 2.50. The Fed targets a range, so it's that between those two levels, and that is good news for the Fed. You know, they're on a mission to stop inflation, and they've done it, or they've said that they started to increase that pressure at a faster pace. Indeed, you know, the 75 basis point hikes have gotten them to this level much quicker than, let's say, at the beginning of the year when they were thinking that there was no chance that we'd get this far this fast. The expectations at the end of the year is for a rate of 3.5%, 3.25 to 3.5%. That would imply, 25 basis points or so hikes between now and this week, at the end of this week, and the rest of the year. Whether or not that's true or not, I don't know, but the commodity prices are coming down. There is some relief as far as inflation goes, and remember, inflation is, it's not necessarily, it's just a leveling of inflation is that price hikes stop. And so if commodity prices start to come down, oil prices start to come down a little bit, then you're going to get actually month-on-month negative numbers, and that's going to start to eat away into that year-on-year inflation measure. So anyway, that's a key event. We also have lots of earnings coming out this week. Amazon, Apple, you name it. It's Boeing. You name it. It's coming out this week. So that's going to be an influence on the market. Also, we have in Australia, we have a CPI data coming out on their Tuesday morning, Monday night in the U.S. And so we have that to look forward to. And also GDP in the U.S. will be released on Thursday at 8:30 a.m. The expectations are for a small rise in GDP quarter on quarter. Remember, the first quarter we did have a negative reading in GDP, but the Atlanta Fed GDP Now model looks for a negative GDP, so 2 quarters of negative growth would technically be called a recession, which I don't know if it's good or bad. It doesn't, it's not really. I think the market is a little bit more focused on the now and the going forward as opposed to what happened from June to January. But in some respects, it might be that, we had the recession already, so let's get things going. But all is still going to be dependent upon the economic situation and inflation and markets' expectations and interest rates, and also we've got a lot going on in the markets. There you go. My preview from a fundamental perspective. Now let's start to take a look at the technical perspective in some of these major currency pairs. The euro versus US dollar. Well, first I want to post up or take a look at this headline that Adam wrote over the weekend from SocGen, saying the euro is still unbuyable despite the ECB 50 basis point hike. Yes, the ECB did raise rates by 50 basis points, a little higher than their 25 basis point expectations, although there were some who thought 50 basis points would be, there was certainly some chatter in regard to that. So SocGen is saying that that the euro is still unbuyable despite the rise that we saw over the last few weeks, where the price moved down to a low level of 99.515. below the parity level in not this last week but the prior week. And last week we saw rises on Monday and Tuesday, and Wednesday, Thursday, Friday were sort of up and down price action, as you can see here on the daily chart. Now on this daily chart, I put a Fibonacci retrace from this high to this low, and the 50% retracement comes in at 1.02829. And as you can see, the market tried and tried and tried, and Friday didn't really get close to that, but it was sort of like the little engine that couldn't quite get through the 50%. And this is just of this range right here. So that's a problem. The buyers had their shot. ECB raised rates by 50 basis points, but they couldn't get through the 50% retracement level, which is a little bit of a problem. Nevertheless, the level remains a key level going into the new trading week, and if the market's able to get above that level, I'm going to be taking a look at this area right here between 1.033395 and 1.03657. That represents lows and lows right here. But also, if I go further deeper back into the weekly chart here, here are lows and lows that I just showed you. And if you go all the way back here to 2016 and early 2017, we had a number of weekly lows that bottomed in that area as well. So as you can see that the lows in June and lows in July through here were, or actually this is May and this is June, these lows right here were taking their clue from way back here. And so that's when the market broke below that level, we saw the momentum to the downside moving our way down toward the 99.50-ish level, and now we're moving back up. So that level, if we are able to get above the 50% right here, would be the next target on the top side for the euro versus US dollar. Another key level, so 50% and this area right here are key levels. Let's drill down even further to the hourly chart just to see what would hurt the quote-unquote bullish bias that we've seen over the last few weeks. And we close a week right near the 100-hour moving average. That level comes in around the 1.0203-ish or something like that level. I can't really see it there. The 200-hour moving average, the price moved above it on Monday's trade and stayed above it for the rest of the week. And you can see on Friday's trade, the market came down, kind of sniffed it, didn't really get that close to it. But this 200-hour moving average is going to be a key bias defining level in the short term. For the buyers who think that there's a dip, this might be the opportunity to buy against that level and push the price eventually through the 50% if we head down that way in early trading. Alternatively, if we're able to stay above the 100-hour moving average early this week and push through the 50%, that's going to be more bullish than the top side. But move below this level, things aren't looking good from a technical perspective in the shorter term or longer term. All this move was just a minor correction and a very small trend move to the downside. Just this move, there's a lot of room over here to move to the upside, but you got to learn to walk before you can run. And so far we're still crawling here in the euro. We need to get above the 50% of this little move in order to push the price higher. Okay, so let's take a look at the dollar versus yen. And if we look at the dollar versus yen, this high right here, I have to actually go to another chart here. I'm going to take a look at the what is the monthly chart of the dollar versus yen, and we moved up to a high price this month that took the price all the way up to the highest level since 1998. And as you can see, the price has rotated back to the downside this month, and we're trading near the lows, which has some people saying, as the dollar yen reached its peak. And what might be key going forward, at least on this monthly chart, is these highs right through here. And this high came in at 135.16. Now this month, the low earlier in the month moved below that level, but we're moving back down toward that 135.16 level. Put that on your piece of paper right now. Mark it as a level that we can watch for this week. If we go below 135.16, maybe there's more to this the dollar yen has reached its highest level. Okay, so let's go back to the not that. Let's go to the hourly chart here, and we'll take a look. Here's that 135.16 level. So I put a red line across that level just to show you, and you should do it too, of the importance when you look at the shorter term chart this week. What that level is going to be key. So and in the past when the market went below that level, there was some, at least trying. There's above and below movements through here, so the market's sort of unsure of what it wants to do at that 135.16 level, and then we moved above it on this day, which was July 6th, and we pretty much stayed above that level. So keep that level in mind going forward. Now, the price action to the downside that has people thinking the dollar yen might be moving down was largely more bearish this last week. The price initially found support against the 200-hour moving average here, and we did move above into this extreme high area. Remember, this is highest level since 1998, and we moved above that level on Thursday's trade. This is after the Bank of Japan interest rate decision. And then the market started to fail. We moved below the 100-hour moving average, moved below the 200-hour moving average. And what I want to point out to you is the way that the market held below those two moving averages right through here. That's key. That's key, folks. And that gave the sellers the go-ahead to push to the downside. So traders who took this correction to the upside leaned against these areas right here, had to risk just a little bit to make more than a little bit on the downside. Pretty good trade actually in the short term for you traders who are looking for opportunities, or always look for that sort of correction into converged moving averages. It's a good trade idea. Now on the downside, I drew this trend line connecting low, a low, a low, a low, a low. So a number of different lows makes that level important. And on Friday the market did move below that level, but did bounce back. And we're into the week above the trend line. So in the short term, what we're going to looking for next week is a move below that trend line that would potentially lead to further downside momentum and keep the bearish bias going in this currency pair. Up here would be a close resistance level. We have it high here, we have it high here. We moved above that and failed, and then broke above it here. And then it became what was once resistance became support, and we hadn't moved back to that level until Friday's trade as well. So watch this at level in the short term. So we have very, very close levels here in the short term to start the week. One around the 135.90-ish type level, and the other one near 136.38.46. So take your clues from that. If we move above that level, then we should start to look toward other levels, including 137. That would be another key target. Why? Because it was a swing low right here, and if we go back in time, it was a swing low right here. There's also a swing high right here. So we always look for those types of swing levels where the market pays attention, not to mention that it's a natural resistance level at 130.37. So watch those. On the downside, again, if we break below the 135.16 level, it should be open door policy down to the other swing lows that we've seen through here going back to June 23rd. Then we'll see what happens from there. Okay, that's the dollar versus yen. Let's take a look at the sterling versus the US dollar, starting off at the weekly chart here. And not last week, but the week before, the market fell below the lowest level going back to 2016. In 2020, the market moved even lower right there, but so we only made another new low going back to 2020 through here, but it did fall below this level right here, which was somewhat significant, but could not stay below that level. Comes in at 1.1840. The price has moved higher, and in last week's trading, we moved up to this swing low. Again, we have a series of swing lows through here, and so they all sort of become important to get above if the market's going to move higher, but we couldn't necessarily move much momentum to the upside. But watch that 102.73 level in trading this week, and you can see here how the high price came just round to it in the last on Friday's trade and found resistant sellers against that level. So key level. Let's move to the hourly chart. And what we see on the hourly chart is, first off, on the high that we saw on Friday, it did move above the 50% retracement of its move down from going all the way back to June 27th. So the June 27th high down to the low that we saw on July 14th. Price moved above that 50% retracement level, and also breached these highs going back here. These weren't the 50% at the time because we didn't reach the low until here, but the market was able to breach through that 50% and extend up to a high price of 1.20633. However, what happened? The market couldn't sustain the momentum. The market failed. Price moved back below the 50% retracement, and it was pretty much to the downside through these days through here. On Wednesday, we bottomed for the week, breaking below its 100-hour moving average in the process. But by I'm sorry, this is Friday's trade. So Friday we broke below the 100-hour moving average, but could not sustain momentum. We started to move back to the upside. Now, this level right here between 120.02 and 120.06, okay, and just above the 1.2000 level, which is a natural resistance level. That's where the market is somewhat is settling near that level, and I have that sort of earmarked as the barometer for the buyers and sellers in this week's trading. A natural level, some highs that have been trying to form a ceiling and then a floor right here. So get above it, it's more bullish, and we start to look toward the 50%, move below it, get below the 100-hour moving average, and we go down to test the 200-hour moving average, where the market traders tried to move below it on Thursday and a little bit on Friday, and then found support against the level before moving to the upside. So we have to get below the 200-hour moving average and stay below that level, and then we'll start to work at around the 119 level on the downside to get through that level to increase the bearish bias to the downside. So key support, resistance, barometer, whatever you want to call it, at the 120 level. Stay above is bullish, move below it's bearish, then start to look toward the 50% on the top side. Get above that, more bullish. Get below the 100-hour moving average and the 200-hour moving average on the downside, more bearish. Let's take a look at the dollar versus Swiss franc next. And what we see in this currency pair is like, big reverse W, I guess, through here. Market fell below, or I guess you could call it an M, I guess, but whatever you want to call it. It's some big waves going through here, where we basically had a double top, and then we fell below the low area right through here, and then moved down and moved below the 100-day moving average for a single day through here, but as you can see, closed above that level. No close below the 100-day moving average since going back to this day right here, which is March 31st, 2022. So then we moved back to the upside and spending another move to the downside here. So there's lots of very bullish, very bearish, very bullish, very bearish, very bullish, and bearish. And where do we move down to on Friday? We moved down to the 100-day moving average. Let me move this over here and get it more in view. To the 100-day moving average at 0.9599. That's a key level, and the market, that's going to be the barometer for the buyers and sellers in the new trading week. Stay above, and the buyers still in play, hoping to bounce off of that level, move below, and we're going to start to retarget the 95.44 level and start to look toward 94.94. Just taking a quick look at the hourly chart here, and what we see is the bearish bias here through the week. Why? Because the price moved below the 200-hour moving average, and then here we are again finding resistance against the 200, gives a go-ahead for the traders to move to the downside. On Thursday's trade, the lower 100-hour moving average became resistance, and we started to move below that level. So the 100-hour moving average becomes a key level as well. It's moving lower over time, so watch that level as a barometer on the top side. If we're able to stay above the 100-day moving average, it's right here anyway, stay above that, we're going to be, traders will be looking for getting above the 100-hour moving average to give more of a bullish bias for that, for the currency pair. Absent that, move below the 100-day moving average, and we start to look toward our recent lows that we saw in June down through here. All right, let's take a look at the dollar versus Canada. This is an interesting pair. I'm going to start off taking, and I did a video on this, so if you want to take a look at the YouTube video page, you can see some information in regard to that. In the dollar versus Canada, we have the low from last week, corresponding more or less with the low going back to June 28th. And so if you blur your eyes and you see a shoulder here and a head here, it's on its way to potentially making another shoulder through here on the head and shoulders formation. So that's a little bit more bullish. We're above the 50% of this move to the upside right here, so that's also bullish. 128.69 is where that level comes in. So keep that in mind. On the daily chart, there's a little bit more bullishness in the short term, just on the back of holding this level. And if you blur your eyes, you can see head and shoulders starting to develop. Now let's take a look at the hourly chart and move to the upside, move back to the downside. We completed the lap up and down, came down to our low, found the support, and on Friday, big move to the upside here in the last few hours of trading, afternoon trading. Market moved above this swing area right here between 128.53 and 58, and then moved above this swing area between 128.92 and 129.07. Also within that area is the 100-hour moving average. So, and we moved up to yet another swing area, and this is defined by highs and highs and highs and highs and lows and lows and lows. And breakthrough here and a low right here and another breakthrough and a high right here. You get the idea that why we call it a swing area. Lots of swings going on around that area. And if we move above that level, we'll be looking for the 200-hour moving average as another indication of the buyers are starting to push back into the dollar versus Canada, pushing the price to the upside. We'll see how it happens if the price moves below the 100-hour moving average in the short term and starts to break down to the downside. That idea of the head and shoulders starts to go away, and we also turn a little bit more negative in the shorter term for that currency pair. Aussie versus US dollar, daily chart here, have a trend line cutting across here, moved up to test that trend line. Also a swing area, swing low, swing low, swing high. So sort of took use this level as a resistance level through here and here. So that's I would use this area right here as a key resistance, a key barometer for the buyers and sellers starting the trading week. Move above it, it's more bearish. Move below it, it's the bias is more to the downside for the Aussie versus US dollar. Let's take a look at the hourly chart. And on the downside, if we are below that area on the top side, and if the market should move below the 100-hour moving average, we come and sniffed it on Thursday's trade, didn't find the buyers or found the buyers there also near this swing area. And so if we move below the 100, move below that level, and then move below this level at 68.52, swing low right here, swing low right here, automatically sort of makes it a level in my book, I guess. And then the 200-hour moving average, things would turn more bearish. So again, on the Aussie versus US dollar, we tested key resistance at the high. Need to get above that level on the hourly chart. On the hourly chart, if you start to move below the 100, this level at 68.52, and the 200-hour moving average, things would start to be looking a little bit more negative. Finally, in the New Zealand versus US dollar, again, the 50% retracement of this move, the last move down from the June high, comes in at 63.17, 0.6317. We sort of got close to it, but didn't quite get above it. So still not out of the woods for this pair. What we did do is that we did move above these swing lows from May and June between 0.6196 and 0.6212. If we're able to stay above that area, that would be more, I would keep the buyers still in play, okay? So keep that area in mind. And here on the hourly chart, the 100-hour moving average and the 200-hour moving average are going to be key on the downside. We held the 100-hour moving average here. We fell below the 100-hour here, but could not sustain momentum down to the 200-hour moving average, and then reestablish support against the 100-hour moving average here. That makes the level still important, and or increases the level's importance going forward. So watch the 100-hour moving average in early trading. There you have it, a weekend look at all the major currency pairs. Hope you liked it and learned from it. Maybe set up your charts to be aware of these levels in the currency pairs that you do watch. Again, another big week as far as the Federal Reserve goes, so we may have some price swings as the market prepares for that decision on Wednesday, and lots of earnings, which are, have the potential to create volatility as well. But so watch those levels. There's a lot of key levels that are in play, and they'll give you clues from both a fundamental and technical perspective. I think the story will be defined by the price action, and that price action and the tools applied to that price action give traders the advantage, the ability to define risk, limit risk against those levels. Don't forget that. My name is Greg Michalowski. Good fortune with your trading. Have a great week. Bye-bye.